Let me get. Hello, everyone. Welcome, welcome. I'm just going to give it a minute. It looks like everybody's jumping in. Hello, Alan, Ben, Chris, Dan, Daniel, David. Oh, man. Jim, Jenny, hello. What's up, everyone? Welcome, welcome, welcome. I'm just going to give it like 30 more seconds because it's still filling up. We're probably going to have maybe, I don't know, 100 plus people in here. So welcome. We are really excited to give this presentation today. We do this every time. This is not the first time we've done this, and it might not be the first time that you've attended one of our calls. What we like to do is go through the property and any project that we get and present it to you guys for the first time before we email our investor list, everything, email out the recording, all that stuff, and give you the opportunity to jump in with us before everybody else jumps in. So we post it on social media and all that stuff, and then give you an opportunity to answer questions. So the way it's going to go is we'll present the opportunity that we have, which is a 375 unit building in Chattanooga, Tennessee, right down the road from us, where we've done some deals before. And then at the end, we'll answer any questions that you guys have. So we'll go through maybe 20, 25 minutes of a webinar, just kind of going through where we found it, some details about the project, some of the returns that you can expect and what it's going to look like. And then at the end, we'll answer any questions. So, all right, you guys ready to go? Jason, Chad, ready? Cool. All right. Oh, by the way, before we start, there's an area where you can answer questions. So there's a chat and there's a Q&A feature. So it really helps me if you have a question, just drop it in the Q&A. And the chat sometimes kind of gets a little busy. Drop it in the Q&A. We'll answer the question. If we can answer it right there, we will. If not, we'll do it towards the end, okay? So right down there at the bottom, you'll see a chat and a Q&A. You can obviously put stuff in both, but we'll be monitoring them along the way. So that's the best way for you to, put some information in where we'll answer it. All right. So welcome to the call tonight. We're going to go through the Rustic Village. So, and we'll talk about kind of the different properties, but it's 375 units in Chattanooga, Tennessee. You can go to the next slide, Chad. Thanks. So I'm Bill Allen. If we haven't met, I own a company called Blackjack Real Estate that I started about 12 years ago. And then I run a company called Seven Figure Flipping, which is a coaching mastermind community. That's where a lot of us met, Chad, Jason, myself, Jason's wife, Peely. A retired Navy pilot. So I flew airplanes and helicopters for the Navy for 20 years, was a test pilot. I'm a full-time real estate investor now and coach. And then wrote a book called Seven Figure Flipping Underground. I got about 4,000 rental units. We built some self-storage down in Orlando. I love connecting people to things like this, to opportunities. I love to help people build their wealth, cash flow, and their tax benefits. So something I like to do. 9 full cycle exits, a lot of money placed. So a lot of you are probably in a deal because we've met before, or have followed my money into other projects like this. So I have 3 kids. I have a 13-acre farm in my backyard, and I love systems, procedures, and operations. So that's a little bit about me. Jason.
Perfect. Good to meet everyone. My name is Jason Urisi. On behalf of my wife and myself, we are the founders of Urisi Holdings. We've acquired a little over 3,000 units back since 2016. We started actively investing in multifamily at that time. Before that, we had actively invested in all different formats of real estate. And prior to that, had owned bars, restaurants, owned at one point a brewery and a large construction company. Big focus here in the multifamily space for the last almost 10 years now, with a big dedication here in Middle Tennessee. We're going to talk a lot about why we're really bullish on this project. I myself, we have 3 kids. We also have a small farm, not quite the size of Bill's to date, but that is not a requirement to be an investor in this deal, has to have a farm. All right, kick it over to Chad.
We also have a small farm that we had to shut down due to our chickens getting killed, but that's another story. Chad King, on behalf of my wife and I, we own Titan Capital Group, entered 25 commercial properties. 12 of them have taken full cycle, currently manage 132 million. Most of it right here in Murfreesboro and Chattanooga. Average rental price point is this $1,200 a month, which you'll see from the Rustic Village. That is our sweet spot. It's kind of our bread and butter, this vintage, this product, this structure. So yeah, I'm a family man. I like to play golf in my free time and hang out with my wife, and I have 2 beautiful kiddos as well. So I've been working with Bill. I've known Bill for the better part of a decade. Same thing with Jason, and been working with these guys for a long time on a lot of different projects. Very much a core values fit, and we are all operating in the same freedom-focused mindset. So this is Rustic Village. So it is comprised of 2 properties. This is in Chattanooga, Tennessee, right outside the airport, about 10 minutes from the city. We are buying this from the original owner, developer. They had built it. It's a family kind of property. And the story here is that the father-in-law, or the father, passed away, and his kids had inherited it just a few months ago. And it was time it had been in the family for a long time. And after the father passed, they had come to terms with the fact that they were going to sell it. So they wanted a very, quiet process. We were given this property off market due to our performance right here in Tennessee. One location is 223 units. That's the south property. And then the north property is 152 units, 2 different vintages, 77 and an 86. The big piece here is the compelling basis in which we're buying. If you're familiar with the Chattanooga market, $68,000 per door is about as low as you can see it. We have comps, which we'll show you here in this deck, and everything is pretty much above 100,000 per unit. So the compelling basis is really the reason that we're very bullish on this asset and striking here. This is just 10 miles from our office. We opened up an office in Chattanooga as well. The properties are not far apart either. There's a lot of big industries that have come into this. And if you are familiar with Tennessee, Chattanooga is one of the largest growing MSAs from a population growth and demographics. So it's very well located, very well situated. We plan to go in and do what we do best, which is implement value add strategies, raise the rents to market, improve the property, both interiors and exteriors, and then run it like a business. I mean, due to the fact that the basis was essentially zero for the current owner, and they don't have any debt on the property or anything, they are very, very below market on rents, and they're also operating it to what I would consider what we would call mom and pop operations. So we're going to come in, put in the operational efficiencies, drive the net operating income, and force a lot of value on this project. Some of the deal highlights, like I mentioned, $68,000 per door sourced off market. The other very cool piece of this puzzle is when we look at our return metrics, these are all based on a exit at 105 per door, 105,000 per door, which is below the market comps today. So we are exiting in 5 years at a below market rate today, which we think is probably about as conservative as you can get. And that's a big driver of the high average annual return and high internal rate of return, which we hope to exceed with this project. We're also partnering with our current property manager that has almost 1,000 units of ours, MMC. A big driver in this is MMC's involvement. We work very, very well with them. They have experience doing this. This is not a new relationship to us. So we're very happy with the management team that we're putting in place. And then I mentioned, Chattanooga's projected growth is a big driver here as well. 506C is what we're doing here. 100,000 is the minimum investment. PPMs will be available in just a week. We do have a March 30th close date, or I'm sorry, April 1st close date here. And the funding deadline will be right around March 20th. So starting next week, docs will be available, get them signed, and then by mid-March, we should be looking to fund this deal. Jason?
All right, so here are some of the investment highlights. So we're extending this to investors with the opportunity to invest in Choo Choo Holdings. It's a newly formed entity just to acquire these 2 assets. It's a 506C opportunity, a 5-year hold with investor partners participating in 8% preferred return, and then 70% of the upside above the preferred return. Estimated return metrics are an equity multiple of 2x, an average annual return of 20.07, with an internal rate of return of 16.48% and an average cash-on-cash return of 6%. The investment snapshot breaks out as a purchase price of $25.5 million with a capital improvement budget of just over $4 million. Closing costs, operating capital will be $973,000 with a total capitalization of $31,325,000. Our goal and anticipated target is $9.2 million for the raise, and this is to acquire in total 375 units split between the 2 properties that are built subjectively 1977 and 1986. Current occupancy is 95%. We have achieved a very desirable loan with a bank that's going to have an interest rate of 6.89%, fixed for 5 years with 2 years of interest only. Proceeds, which will include some working capital for the construction of $22,154,000 with an overall loan to cost of 71%. Here's our pro forma. So we're taking on these properties, and there's a different story with each property. We'll call it North property, or just the Rustic Village property, is the 1986 property. It operates better. It's been handled better. It has less deferred maintenance, and it has a higher quality tenant base to date. The South property has a more deferred maintenance, has expended that's where the majority of our CapEx will go. Right now, you see blended rents on some of those units as low as $500. And we will get into the rent comps later, but you will see a substantial delta in terms of what the actual rents are compared to the comps to date. Gross potential rent on our pro forma in year one, effective, including other income, comes down to $4.1 million. We see a big jump in year two due to year one being a very large turnover of the tenant base, primarily at the South property. We're anticipating rolling through, on average, at minimum 50% of those units. And so you'll see a large roll where we're going to do two things. We're going to go and get rid of any tenants who are just not meeting qualifications, or we're going to renew good tenants, hopefully to a point where they will stay with the property. We'll be able to pick up a substantial amount of increases there. And then we're going to force the hand for some tenants that are not desirable tenants for the property, so we can go get access to those units to renovate them, to bring them up to market. That's going to take a majority of year one into year two, and that's where you'll see a big jump in our income from year one to year two. Jump down to expenses. In here, a lot of this is going to be on controlling the operations. We have a big jump where you see this property has been managed, since it is a family property, as we call it. A lot of the income was being derived from this property. So you see a lot of the fees here are accelerated to what is market rate for anything from payroll to property management fees, because this is ideally the payroll, a lot of this was going to the owner or to the family. And so a bunch of our work here will be just to optimizing the expenses. And you'll see a lot. You'll see the property management fee being brought into tolerance. You'll see general administration that's way out of tolerance be brought into tolerance. Contract and services, we're going to keep that number. That's going to still serve a lot to the property. They, right now, because of just how they've qualified tenants, have been able to occupy the units because the rates are low. So there's just a lot of word of mouth that this is a good place to rent. And so just come here because the qualifications are low. And so for our goal to reach and attract new tenant bases, we will have a substantial marketing budget that's going to be implemented to go out and reach the right tenant base. We're still going to implement a lot of payroll. We're going to have a lot of people on here. MMC is going to bring a very desirable team there to go and target putting this property into line like we have all of our other properties with MMC. Repairs and maintenance, as you see this number, $738,000, that's because they're doing a lot of their construction pieces out of their operating budget. We entail our funding this to be able to do these construction items right the first time, so we can get a lot of this deferred maintenance off the board. Everything from parking lots to dealing with trees to roofs to interior renovations. We will be working on a lot of this property to cure this, so we don't have this onset of additional repairs year on year out, outside of just additional operational of repairs. Turnover costs, same thing. We're going to be doing moderate upgrades across the units to match the market. And we feel a moderate renovation package is going to be able to drive rents considerably compared to where they sit today, as we'll talk to later on. We have two things. Insurance is a big piece. He's had some losses. He's had a fire on the property, and he's had a couple of freeze losses that are going to have time for our insurance to come down. So we've already modeled it, that we've gotten quotes that have brought the insurance down year one, $100,000. We do feel that we are going to, in the next 30 days, still have substantial savings, that we're going to find that number. So we expect that number to decrease. Real estate taxes, we did, in fact, just get our real estate advisor to come back with favorable numbers. So we also feel that this is going to update into tolerance, because we had modeled in 2 consecutive 33% increases based on the purchase price. But now the numbers are going to trend back into tolerance. Utilities, same thing. Our goal is going to be able to, with market, push some of this back into the income line. So we will still have this utility line item here, but to find the ability to put this back onto the tenant responsibility to garner some of this back to increase the bottom line. So as you see right now, our expense ratio, 115%, that is mainly because the ownership is taking every dollar and pulling this out as part of their income, as part of their payment. And so we will get back to just operating this like the business it is. To drive this forward considerably to improve the overall bottom line of this property, and we will see a lot of that happen very quickly in year one. Breakout here, you have Rustic Village is south, that's 223 units, while north is 152 units. Breakouts 59% to south, where the majority of our CapEx dollars can be expunged. Rent in place, rent per unit is $599, while Rustic Village North, $573. Average stabilized rent per unit for our underwriting is $923, with Rustic Village North, $926. When you see our comps, you understand that even at that delta and that number, we are still under market in terms of where we're underwriting this stabilized rent number, and this is just on basic upgrades. Capitalization for our exit is a 6 cap, with stabilized at purchase. We're purchasing this property for $25.5 million, with our anticipated exit at $39,425,000 or $104,000 per unit. We will again get to the sales comps, which will justify our allocation for where our exit is. Again, talking to our loan amount there, 30-year amortization, which is great. Many times with a bank, we will be subjected to a 20 or a 25-year amortization. This 30-year amortization really will help for a few of the years on the back end where we begin to amortize this loan. Rate at current, 6.89, fixed annual debt service, 1.5 million, with a coverage ratio of 1.35 and a debt yield aimed at 9.91%. This recap here on the financial analysis we touched on earlier. We're anticipating to exit at a 6 cap, investor IRR 16.48. The equity multiple target is 2x. So the investor equity invested 8.17, with distribution anticipated at 16.209, with a profit termination of $8 million. So average cash without the sale, cash and cash, means year on year, is target at 6%, with an average annual return over the course, including the profit, of 20%. So if you see the breakout on the right here, a typical or a hypothetical $100,000 investment will garner 4.6% return in year one, 7.8% in year two. You see the downtake, and this is because we will start to have amortization. And so this is actually sometimes a very good silent advantage to the property, because your returns, while they go lower here, will start to pay down the note, which will just help the profit in the back end between year 3, year 4, and year 5, with the profit and capital event at the sale targeting where our total return will come from in year 5. Okay, with that, I'm going to kick this back over to Chad to talk about our property management team, MMC.
Awesome. So I mentioned this earlier. MMC is currently managing 4,000 units. 836 of them are ours. So they are extremely professional. They do a ton of market research. They operate like a business. So their local presence. I mean, we are just 80 miles from this asset, from our headquarters in Murfreesboro, and then we have that other office in Chattanooga. So we have a pretty good game plan with them. And yeah, all unit turns and everything is done in-house. We don't have to sub a lot of stuff out unless it's, a major electrical or HVAC or plumbing thing, but everything is done in-house, including the unit turns. So we are very cost efficient with them, very budget conscious, and they keep an eye on our bottom line. And we have economies of scale. With 375 units, you can get some serious economies of scale versus just buying like a 32 unit or a 50 unit. Here's an aerial shot of the property. So this is the north asset. You have your amenities up here with all of your buildings, and surrounded by all the buildings surround your clubhouse, your pool, and then it's fully amenitized with pergola, grill station, dog parks. It's got basketball court, tennis court that have not been touched and are completely overgrown. So part of our CapEx budget is to bring back the amenities for the property. That's one of the reasons tenants are likely to stay despite seeing the rent increased, because they see the work that's being done to the property. They see that we're taking care of it. that we're putting money back into the asset, and that, you know, the dog park that they've never been able to really go in because it's completely overgrown is now getting taken care of, and the pool has new furniture. Like we're gonna really make this place a nicer place to live. Here are some of the demographics of the Rustic Village North property, including population. You can see population growth projections. You can see some median household incomes, and median home values as well. The reason we like to see, you know, that median home value over 200,000 is because right now with where interest rates are, somebody cannot go get a single family home for cheaper than what they could rent a property from us for. So that there's some demographic targets that we look to hit, so that we make sure that we can stay competitive in the marketplace and somebody can't go across the street and get a mortgage for way less than what they would be able to pay us in rent. Here is the south property. This is the larger one. Same thing, fully amenitized. Here you have the pool and the clubhouse in the center, along with basketball, tennis courts, nice big green dog park area over in the back. And then all of these buildings are a part of this asset. Golf course over here, airport's right next to Rustic Village South. Here is the demographics for the south property, just 6 miles away. Very similar median home price, median household income, and it fits our demographic box for what we need to be charging in rent. So here are some of the aerial views as well. It's situated right on the other side of the Chattanooga airport. You have basically city center right here, about 10 minutes away. This is all very nice golf clubhouses, very nice single family homes in between too. So we're in a very good pocket in Chattanooga. The north property is situated right behind a Starbucks and a bunch of retail. And the south property, this south one, there's a Chick-fil-A right on this street. And I know that's kind of quirky, but it tells us a lot of things because those organizations do a lot of market research. So when there's a Home Depot and a Lowe's and a Chick-fil-A and all these retail centers right around our property, it means that they are targeting, they do a lot of market research. So we like to see that kind of growth around our assets. Here's some more of the big organizations that are some of the employers. So we have VW, Amazon, Cigna, Coca-Cola has got their factory there. So we have a lot of employers. That's another thing that we look for is heavy employment opportunities right around. Some more aerial views and some more stuff along the interstate. So as you guys get copies of this PowerPoint, if you'd like to dive into the markets, here's the Target, Walmart, everything that I was just telling you right off the highway for these very convenient access to go into the Chattanooga market for these properties. I'll kick it over to Jason to talk a little bit about the rent and sale comparables, which again are going to speak to the basis in which we're buying and the value add scenario for this deal.
Great. All right, so I think this would be a good time to address some questions. One question is, what are the approach to bringing in new market rent tenants to a property that has a reputation as a cheaper locale? There's a couple things that are in our favor here. Either property has no website, no marketing, no digital footprint, right? And so for our ability to go in there and put the right marketing plan in, it's going to drive new tenants to the property. With that said, like kind, we did this on a very similar property here where we walked into the property and the property had $500 and $600 rents, where the rents today are $1,100 and $1,350. However, what we were able to do is we were able to go and do renewals and bring the $500 tenants up to an $850 initially. Now we're bringing them up with the next increase because we're just about a year to $950. That said, they're able to pay that rent. They've just been offered cheaper rent, so they've accepted it, right? And with this, the tenants, we've had a very large portion of tenants stay with the current property as we anticipate to have with the good tenants here, because we will still be at a very desirable price point for the market, and we will be making very strategic renovations to make the property better. So you will see that the goal is from an outside-in approach. We're going to make the outside look better, right? So it's going to be a more welcoming place, everything from signage to landscaping to removing trees to working on siding to working on the curb appeal with the addressing the problems that currently exist from a CapEx perspective. And then we're going to do the right renovations to the unit to make it match the market, which honestly, the inside of the units are fantastic. They're very large footprints. They have very large square footage. They feel very spacious compared to our traditional unit. You walk into these and we were very shocked to be straight about the overall size of the unit, of how it felt from a one bedroom to a two bedroom, and even the common space between. So we are not concerned with how many people will not be able to afford the rents, because we think this is going to be in the right price point. But we do anticipate that we do want to drive out the people that do not fit this property going forward, based on our management style and our qualification style, right? So sometimes a lower rent can bring a lower quality criteria person. And in fact, we do have some of that we will find in the South property, but we do feel that we're going to have at least a 50% turnover, which on average is pretty standard across apartment communities for year one, with the goal that we might push even higher based on those turns. But with the ability to go and do strategic renewal increases, that's going to give us a good hedge where we'll be able to keep the right tenant base and still be able to pick up that income while we're doing the renovations to get us strategically to the right market rent going forward. So if you see right now, our subject property on the rent comparable is the first line up, line S, right? Year built in 1976, or 1977 and 1986, 375 units. We have 128 studios, 137 one bedrooms, 110 two bedrooms. So a very good mix there. But if you look here, our studio rent is $725 compared to
Actually pulled from, sorry, Jay, this actually pulled from a report that is not, those are the projected rents on their, like
this is from, that's correct. Yeah. So right now we're blended, but if you look right now, we're renting, going out to our blended here between 725, 934, and 1200. When in fact, if you look at our comps, just on average, remember our blended rent is about $575 and $595 across the property. Here are our comps. You'll see studios anywhere from as low as $892 up to $1349. One bedrooms as low as $999, all the way up to $1564, with two bedrooms as high as 2107, low as 1228. Now, again, our blended rent across this is in the high 500s. So there's ample room for us to be able to increase on our rents across the property, one, based on renewal, and two, based on the strategic renovations we're going to do. Now, if you look at that, this gives credence to just the tenant base, right? If a tenant chooses to move, the choices become that they're either going to pay an additional higher rent at other properties, or they're going to move out of market, right? So it leaves them with choices that honestly is going to benefit our property, because we'll be able to get the right tenant in there that will be able to qualify in the rent.
I think one thing too that we hadn't mentioned up until this point is that we are intending on doing a full rebrand out at this property. So there will be a new name, new logo, new color scheme, new marketing materials, new website, everything like that. So it is very difficult to take something that's been in the market for 40 to 50 years and try and refresh it when you can come in with a fresh name and everything like that. So we will be doing a full rebrand, which we have a lot of experience doing as well.
All right, so sales comparables, we talked to this earlier. Our price per unit at purchase is $68,000. Chad and team, they spent a number of months, and that's why we're coming to you now, working on the negotiation to get the right purchase price for this property, for where we feel gives us the room to be able to make the repairs we want, improve any operations, and get the desired returns. So our price, $25.5 million. If you look down the line, anywhere between as low as 12 units up to 193 units here. Purchase prices, and these are all within the last 18 months, are anywhere between 105,000 all the way up to 127,000. So
Right.
this market drives a very attractive price point. Chattanooga has a lot happening, has a lot of people driving to this market, and a very attractive real estate market. So we feel great where we're at with this property. We feel that we have walked into a really awesome opportunity with a ton of upside built in, with the ability for the North property to really just optimize on operations, which, without a tremendous amount of CapEx needed on that property, with the South really being a big upside swing for us to be able to capitalize on putting in the right renovation dollars and the right property management to really drive that property to really excel, like we see on some of these other properties here that are selling in the sales comps.
Yeah. And I think the fun thing, I'll mention it again, like you look at the vintages. So we're all on a very similar vintage for what we're pulling on the comps. And then you look at the sale dates, obviously all being recent sales. our our exit price is still the lowest on this board. Our exit price at just under 105 a door is still the lowest on this board, and that's 5 years from now. So if you believe in, appreciation of this asset class, then this is a very, very strong basis to enter and a very strong basis to exit with much upside on the back end.
Hey, Chad,
Investment.
before you move on, so if you're kind of new to this, what Chad is basically saying is we're being conservative on our numbers, and I think you'll find that if you know us or if you worked with us, we underwrite these things really hard. We've been talking about this property for probably 3 or 4 months, and only bringing it to you now when it's all like, the I's are dotted and the T's are crossed. And so there's a lot of conservative things that we try to do inside of here, where I think a lot of the other things that you might see or have been on the market or people that you've been on some of these calls with before, may be pushing like and stretching some of the numbers. So what Chad's talking about here being the lowest comp on the board here. If I push Chad to put this at 120,000 a door and give me those numbers, and you saw those kind of returns, you'll be shocked. So it's very interesting to see what will happen over the next 5 years. We want to be conservative on the front end. I'd rather under promise and over deliver for you is effectively what we're talking about here.
Yep.
I'll jump into a couple questions before we get into the disclaimer.
Sure.
So how do we handle economic downturns or unexpected vacancies? So in year one, you see that the income accounts for unexpected vacancies. We expect that typically what you'll call it when a new sheriff comes in town, aka our property management company, you will have people that will skip because they've gotten away for a long time, paying when they want, not keeping their word, not keeping it attuned to the level of the property. And so we're going to make these properties shine. We're going to make these properties perform better. So you will have a 6 months of us really cleaning out the buildings, as you call it right there. That is going to be and is underwritten into our process here, and we do anticipate that. And with that, economic downturns, you can look at the market as you want right now. We have a lot of we have a lot of things happen in the market that are driving the economy in many different fashions. So I expect that, what you've seen, even with the numbers from job growth, will in fact be inflated because a lot of that was coming from government jobs. And so if you look at where it is right now, it's not as strong as the economy out there. And the renter is going to be better for our profile property than they are going to be as a homeowner, because it takes about 3.5 times the funds for them to go and be a homeowner. So economic downturns can work in our favor because that same renter profile, they are not going to skip and jump to go and to be a homeowner. And they're going to stay a renter for longer, and they're going to choose not to move. The goal is to be a homeowner because they don't want to incur the moving expenses to potentially move to another apartment that lowers the ability to them to meet the down payment obligations going forward. And these goals here with the conservative future rents, the question here is, assuming things go as planned, do you expect to be able to exceed those conservative assumptions? Or another way to look at it, have you performed more of an optimistic versus conservative outlook? We are giving you our base case. Our anticipation here is to always outdo our returns, and we've been able to do that on multiple exits here. However, we're putting this through to model this in a way that we know we can perform at with a very good baseline operations. And so you do see this here where there's the ability on many fronts, from expenses, everything from insurance to our repair bills to our payroll, that we have ways to really trim the expenses to grow the bottom line. And on the other side, from a revenue level, we have a very, we'll say we've modeled this to a very desirable number from a renter's perspective. We know we can perform that, but we do see that we're going to be able to outperform that pretty quickly. So the goal is that we meet these numbers, and if we can outperform it, fantastic. If the market wins and continues to push in our favor, it's going to be a more of a accelerated return. But right now, we're keeping to these numbers because this is our base case scenario.
I think one thing to point out too is, MMC, which is the name of the management company, the 836 units that they manage for us now, we are 96% occupied across the board. And that's economic occupancy. So that's a very strong number, and we're able to, and that's also through the winter, which is the toughest leasing season. So
Chad, can you define what economic vacancy means?
Yeah, so there's physical occupancy and there's economic occupancy. So physical occupancy is just how many people are actually in your units, but economic occupancy is how many people are in your units that are current on their rents, that are actually paying. That's a big number because a lot of people, they get a rent roll, they're like, oh my gosh, it's 98% occupied. That's awesome. But really, 20% of those people are delinquent, not paying, under eviction. So your building is actually 80% economically occupied, despite it being 98% physically occupied. So we are 96% economically occupied across our portfolio of 830 units with this management company, which votes to the fact that we understand how to spend money on marketing in order to drive traffic. And if we did have unexpected vacancies, we understand how to offer small concessions to get people and get new leases in the door and retain and hit that 95% economically occupied target metric that we have. Now, during the clean out phase and during the stabilization and renovation phase, then we understand that we may dip. Like, you guys are going to get investor updates, and it may say 88% occupied or 89% occupied. But the idea is that we are turning that, and those pre-leases are coming through, and that we will stabilize out across the board at 95%, between 93 and 95%. So that's kind of answering that question on unexpected vacancies. We have a contingency plan for that in order to drive traffic, but we do expect that in the beginning. Bill, you want to hit some other questions?
Yeah, what's the cost segregation? So advanced depreciation. So Monty, we will do a cost seg on this property, so a cost segregation. And for anybody else, what that means is basically we're going to look at do an engineering report on the project, and we'll get a cost segregation, which means we can accelerate some of the depreciation to have a write-off and a K1 loss in the first year. And so as far as cost segregation goes and the bonus depreciation laws right now, we're at 40%. So in 2025, we'll be at 40% of what used to be 100%. So they kind of step that down over the years. It goes down 20% every year. But that doesn't mean you lose the other 60%. So I think a lot of people think that that's true, where you only get 40% of bonus depreciation, the other gets lost. What it means is we're going to have a couple years of really great bonus depreciation write-offs over it will waterfall down for year two. So what it used to be 2 or 3 years ago is we take 100% bonus depreciation, we write off as much as we can in that first year. Future years would be smaller depreciation. This year we'll have more stable first few year depreciation. However, there's also the opportunity. There is a bill floating around Congress right now, just kind of waiting for a bonus depreciation, 100% bonus to be retroactive for the past 3 years, including this year. So I don't know if that's going to happen. I'm currently planning for my 40%, but it's possible that it could go back up to 100, depending on what they do in the executive branch and Congress. So we will do a bonus depreciation cost seg on it, and then accelerate depreciation. Do we have have we looked at that for, I don't have the exact numbers for you right now, but we will have bonus depreciation in the cost seg that we'll do immediately.
The analysis group is working through this, and we don't have the report back. And so that with just how quickly we've been able to come this together. So we expect that back in about a week or so. But on average, we've seen this anywhere between 35 and 50% of investment. And so that's a wide range, but that's where we've been seeing this come in based on recent analysis.
So what that means, if it hits 35%, if you invest $100,000, the K1 loss in the first year will be $35,000. If it's a 50%, it would be a $50,000 K1 loss. So
the next question is, are you suggesting to keep competitive rents versus lower rents for the South property? We are going to hedge our rents in the first year, right? We know that this property has had a poor reputation in some of the properties around there. And so to drive this forward, we are going to have rents that will step off the market rent, slightly off the market rent, while we make these improvements, right? And so the first tenant in, although they'll meet our qualifications, will have a cheaper rent profile. Then you will see at month 6, month 12, as we continue to make the improvements across property and drive rents up. The next question is, are you, as principals, contributing your own equity into the deal? Yes, we've invested in all of our deals that we've brought to you. We're active investors in our deal. This is our full-time job as real estate investors. And a big part of this is that we find great projects and we invest alongside of you so we can get these awesome returns we find as well.
Yeah, this is where I put my money. So I put my money in our deals. I love it when we have one because I stuff as much as I can in there. Whatever I have liquid, it's going in. So hey, guys, before we go on, can we drop the link for them to make a commitment right now? So is that I don't want
I'll get that in there. if you
Okay, so if you
get
guys are
this.
here and you're like, yeah, I'm in, I'm ready to make a commitment. I'll just talk about next steps a little bit while Jason does that, and then we'll
Well,
get to.
two parts is we have right now as a soft commit, you will have the paperwork is in our hands, and we're just reviewing our private placement memorandum for to be ready for you later this week. But we'll also send out an email when that is in fact ready.
Yep. So if you hit this link, you can go there, and if you don't, if it'll take you to a login screen. If you don't already have a login or an account with us, you can just create one, and then you go in, log in, and you can look at the project. And once you click on it, it'll show a lot of the stuff that we have here, but you can just say make a commitment. And what that'll do is it'll grab your spot, and then we'll be communicating with you on some of the paperwork. Everything gets uploaded to the portal. I really love the portal that we have. You can see all the returns on there. You can see updates in there. You can see what your position is. You can update all of your banking information, so all of your distributions go ACH directly to your bank account. All of those things. So it's a really great system. So all you gotta do is click in there, go through it. If you have any questions, you can jump on all of our emails, and numbers are there. You can reach out to us and we can help you through it.
Cool. I'm seeing a couple questions on the returns, like what's total return on 100,000, and then someone said, is it 20% or 8%? So I'm just going to flip back to this page real quick and just cover, the expected returns. It is a 20% average annual return. So on 100,000 invested, you're basically getting 200,000 back in 5 years. This is going to be a double. Cash on cash is a little bit lower. Some of our other ones have been up closer to 8%. Cash on cash is now at 6% on this one because it is a heavier value add. But like I said, we have a little bit more runway on the back end for our IRR and our average annual return, with that sale price being kind of at that conservative 105 number. So we're really hoping to exceed that average annual return. But for those asking, this is how your hypothetical investment on 100,000, if you want to go to this slide, this is what you'll see. Now, I don't anticipate doing a distribution in the first 2 quarters of ownership. We're really going to be getting stabilized out. But by the second, maybe the third or fourth quarter, we should be shooting out our first distribution and hopefully hitting that 4.6% in year 1. It is an 8% preferred return. So you would getting the first 8% of all the returns are coming to you. But this is how, on this slide, exactly how $100,000 invested would shake out.
So, hey, let me jump in and just kind of explain. Very easy. When I first started investing in syndications, I was a little bit confused too. I was like, okay, 20%, 8%, 6%, like what does it really look like to me? So this slide right here, what it means is once we start distributing funds, right? So $4,600 is what we're targeting to distribute that first year. So like Chad said, it might be Q3 and Q4 before that starts coming, which is why it's not 8%, it's down closer to 4. So it's a value add property. We're putting a lot of money into renovating the property. And in the second year, you're getting closer to that 8%. And then just like Jason said during the presentation, year 3 is when the interest only gets kicked out. And now we're paying principal and interest. So the returns go down slightly, but our performance is up, right? But now we're just paying down principal as well. So if you look down at the bottom, if everything goes the way that we mapped it out, you'd be getting $30,000 in cash flow. So that would be being paid out on a quarterly basis over those 5 years, which is where we got your 6% return from, right? For your $100,000 investment. But then the capital event, when we sell the property, you get your principal back plus all the equity return that you have for $171,000. So when you combine those, that's where your 20% comes from. You're getting back $200,000. So a typical $100,000 investment would kick out $30,000 in cash flow over those years, and your $100,000 back plus $71,000 and some change in a return on the sale. So the sale of the asset, just so you guys know, that's where we make money. So your 8% preferred return means we're paying the bank, then we're paying all the limited partner investors up to 8%. And if there's anything on top of that, then we split out the equity where we do the 70-30 equity split. So if we hit our 8% accruing returns, we could distribute more than that, and that's where we get paid as partners of yours. So as the general partners, we want the exit. We want to do really well. We want you to make more than 8%. We want to make sure that this return is really, really good because that's where we make our money. So hopefully that explains it a little bit more basic for the folks that are just kind of getting started and understanding this model. Okay, the next one is, can you share some details about your past syndications and their performance? Oh, did we put in the link?
I put the link in there. I'll put this my website in there. Chad also will have, and same with Bill. If you go to my website, you can see some of our past performance on projects. I'd be happy to share that as well. You can go there under just investments.
Okay, I just dropped it to everyone. So sevenfiguremultifamily.investnext.com, sevenfiguremultifamily.investnext.com. So you can just click on that link. It'll take you there. And then the website is urusiholdings.com. So you can see some of the returns. I can tell you, I don't know. I don't know that we can quote an average of what's happened, but I started investing with Jason and Peely very early on, and what I love to see is the under promise and over deliver model. It was well over 20% of what I was seeing. We did have one where we exited in Baltimore and we paid the preferred return. We actually didn't take a fee on that. We didn't make money as partners, and we rolled that into another deal. So that's probably the one that we saw that was a little bit of a challenge for us, if I'm being completely honest. We've had, I don't know, Chad, you've done 20 some deals, probably Jason, you too. And that was a single. We've hit some home runs, but I heard Chad say double earlier. Like we really go for the doubles. Like I'd rather, swing for a double and hit it over the fence. And I think this is going to be a really good deal for us long term. I'm really excited about it. And normally we're holding these properties for 7 years, and this one is a 5-year hold. So a lot of times that's what people ask is, how long are we holding this property? Why is it 7 years? This one in a 5-year timeline and still getting a 2x multiple is really, really good.
Yeah, if we go through our exits, and average annual return have been, on the low end 17% all the way up to 55%. So those were all modeled to lower return thresholds, and we chose to exit those properties because we had well exceeded the overall goals for our returns.
Yeah.
And we're also, I was going to say, we're also very opportunistic to the market, right? If 3 years passes and there is an offer on the table for 120 a unit, like we will seriously consider it. If 2 years goes by, we stabilize, rates continue to come down, and there's an opportunity to refinance this property and get you a lot of your principal back, we're going to likely exercise that. So we are like, I know the term of the loan is 5 years, so something has to happen in year 5, but we're opportunistic to the market, usually starting in about year 3. We're going to start, testing this thing and seeing how it goes. And if we can far exceed returns, early, usually we will always elect to do that, and just make sure we're taking care of you guys.
Yeah, I'll also say I, I'm very picky about what I invest in, and these guys are as well. And so I said it in my email to everyone on the invite here. We've been really picky about what we're picking and what we're saying yes to, especially right now. So the conservative nature starts all the way in from the front. We have to underwrite hundreds and hundreds of deals to get to this one. So a lot of people are like, hey, should I invest in this one or the next one or the next one? Like, I don't know when the next one's going to be. So don't wait for the next one. Like you invest in this one. And then, whenever the next one comes, then you see where you're at to invest in the next one. Like the best time to invest is right now. And we're really picky about what we're doing right now, especially in the market. So, okay, I got another one here. Thanks for the meeting, fellas. What variables drive the 100K minimum for this one versus other people at 50K or us in the past at 50K? This is a big raise for us, $9.2 million. So one of the reasons were the amount of investors that we have to manage, the people that come in. We wanted to bump up the minimum here to make sure that we didn't have a couple hundred investors. We've got a core group of people that we're working with very directly with this asset, and a $9.2 million raise. That's a lot of people to manage if everybody comes in at 50K. If you do have a special circumstance or something where you want to do a portion of an IRA or a portion of cash or a combination of the two, and if you don't know that you can invest in your IRA or 401K, please reach out to me or Chad or Jason. We can walk you through that. We can hold your hand through the process of converting an IRA or 401K into a self-directed account where you can invest with us. But if you got something like that, please reach out to us. Okay. And yeah, go Navy. Will's a Navy guy. All right. The next question is, let's see. Can you clarify what you meant by seeing your position? I think you like in the account, you can actually see, how much you invested, your position being like where you are, how much payouts have happened already. Just kind of like your financial position, like you would be logging into, I don't know, like Vanguard or Fidelity or something like that. So you can log in, you can see what position you have, and not mean like first, second, third position, but your position as in financial position in the investment.
You have an investor portal, and that's how you'll be able to track your investment. And so when you make your commitment, you'll go through the seven-figure .investnext.com site. And you can be able to place your commitment there, and then you'll be able to go back and track your commitment as long with everything from your distributions to your tax documents that will come out each year.
Okay. Any other open? I don't have any other open questions. So if you have some questions, drop them in. You can go to sevenfiguремultifamily.investnext.com and grab. You can just click right there, make a commitment, and go through it. We will also. I saw some other questions like, will this PowerPoint be available? Will this recording be available? Went fast. You want to listen to it again? We will absolutely send this out. It'll also be in the portal. So the best place to go is in the portal. You can see the slides. You can see the recording in there. Set yourself up an account. We'll also update you about the project and things that are going on. So if you guys have any more questions, drop them in here. Okay, yeah, web address slowly. The number 7. So if you open the chat, it's in the chat also. But the number 7-figure multifamily.investnext.com. So 7-figure multifamily.investnext.com. And oh yeah. Hey, Jason, can you drop that into the everyone? Just go to
I
everyone.
don't have access to that. You
Oh,
have to,
okay. I'll drop it in.
some of you may be through the other investment portal, yh.investnext.com. You can
Yeah.
also use that as well. Robert, you mentioned you're having a problem with multiple investments with InvestNext. If you send us an email, we can help you because InvestNext can combine that. So you have one login that will now, they've upgraded their portal, I think 8 months ago. So you can have one login that can now show all of your investments, which is really great if you have invested across a couple different projects that use InvestNext.
Yep. And then you can always, if you can't hear me or you can always email us, bill@blackjackre.com, jason@urushiholdings.com, or chad at titancapitalgroupllc.com. So you can email any of us or all of us and we'll help you walk you through it. If you have some problems with the paperwork, any of that stuff, that's what we're here for. Our team or my team or, each of us, we can help you walk through the paperwork, answer any of those kind of questions.
We will have, so anticipate that tomorrow we will send out the replay of this webinar, and we will also send an update email when paperwork is ready to go live, with latest being Wednesday.
Can you guys answer Chris's question on the early exit? Do you guys see that one?
Prepayment penalty, Jay.
Hold on one sec. I don't see it.
Is there a prepayment penalty if we exit early for the loan? What do we have?
There is no defeasance, but there is a prepayment penalty. We have a swap with 50% of this loan, and depending on where interest rates are, if we break the swap early, we will have a termination fee. Now, if rates go up, that will be potentially in our favor. We'll get money back, but if rates go down, then ideally we will have that payment penalty. However, with that, the loan tracks where we will get the savings, basically where the loan will sit.
Yeah, but we'll factor that into if we decide to exit early, obviously the prepayment penalty, whatever it ends up being, gets factored in to the basis. So
Yeah, and what Chad means for those of us that aren't used to it is, if we get a crazy ridiculous offer that's insanely high, we're gonna math it out to say this is the prepayment penalty for us to sell early, and then does it make sense for us and our investors? Just remember, like, we're on the same team. We all want to make money. Like, we want to make as big of a return, if not bigger than you guys do. So, we math it all
had
out.
a loan in Chattanooga on a property that we were in Chattanooga, and we got a crazy ridiculous offer, and we had an agency loan, and we looked at it, and it was like a $400,000 prepayment penalty, but the offer was so good, we were like, let's take it. It ended up being like a 46% IRR to the investors, and it was like, it made it a no-brainer. So we'll factor that in on the deal.
Yeah. I don't know the answer to this next question. Soft commit has a class A and class B. Did you guys go through that?
You will be class A. So that will be corrected tomorrow, but you will go class A. But regardless, if you click the wrong one by accident, class B will correct it on the back end.
Yeah. Yeah. So when you're in there, just go to class A, make your commitment class A. If you messed up already, we'll fix that for you. Okay. How long does it take to get a self-directed IRA set up and fees? Great question. So I have a great company. I think we all pretty much drive traffic to Advanta IRA down in Tampa. And I can get you set up probably in 2 weeks if you're really fast. I have a connection there that can turn investors for me very, very quickly. So if that's
It's
something,
actually the through line there is you can be set up, Bill can have you set up in 2 days. But what's going to take time is that it's going to be the transfer from where you're holding your other retirement funds. And that can take anywhere from a fast step of 7 days all the way up to 2 weeks because they're going to request that funds to come over. And then it's going to be on your current holder or provider to be able to transfer over the funds. And that's usually where the lag is, where Advanta rocks and rolls, you're set up, ready to go, just waiting on that transfer to come in.
yeah, there's two things that are going to slow you down. It's that transfer from your custodian to them and paperwork being right. The other part is how quickly you get the paperwork signed, get it over, respond, those kind of things. So can absolutely help you push that. And I have some tricks to some of the different accounts and people that are over there. So reach out to us and we'll help you walk through it. And then fees, you can see the fees on their website. You can go to advantaira.com and check it out. But I mean, you're paying expense ratios, probably active management fees inside of an account, potentially things like that. So they're not usually more expensive than the expense ratio that you're already seeing inside of a trader account or a stock account, from what I've seen. So I love Advanta because they're high touch and lower fees. You see a lot of these IRA custodians that are like low touch, low fees. They don't handhold you very much. They're not a white glove service, but their fees are lower, or their fees are insanely high and they do help you and handhold you through. So I love them because they don't have high fees and they're also high touch. Here, I'll drop you can blow up my contact there. I'll drop an email in the chat.
Cool. Thank you, everybody.
And listen, there's three of us on here, Bill Allen, Chad King, and myself, right? You've come through one of us, right? Or potentially, one of my wife, Chad's wife, right? You've come to this through knowing us. So if there's a question that you don't feel comfortable asking here on this call, feel free to reach out to, whoever you're connected with here. And we'd be happy to talk to you further on anything, if it's more of a personal nature or just a more direct question on your investment status or just more investment questions that you want more fine tuning on.
Yeah, totally. I mean, we're here for you. So don't be shy reaching out to us if you're like, I understood like 10% of this. Can you walk me through it? We can jump on a call and talk you through it. So excited to have you guys. This is a really exciting project. I'm pumped for this. It's been a while since I think it was like Q1 of last year or Q2 of last year when we closed our last apartment building. We've been working on that pretty much nonstop. Chad mentioned it. It was a big turn, a lot of CapEx that went into that property. We talked about raising the rents and the strategy that we built. And so we've tested this model. It works. It's going really well for us in Murfreesboro, Tennessee. We're excited to put it in play in Chattanooga. So we appreciate your time too. Have a great night. And
one last question here for William Genos, who's having trouble with the website. Can you ask for his email and I can shoot him an email to help him further?
Yeah, absolutely.
So William, or you can put our email in, you put my email in, in fact, and you can email me directly, William, if you want to share your email.
Yeah,
Cool.
there you go.
Thank
And
you.
and we'll send out the recording. We'll send everything out. If you go to either one of those portals, you'll be able to watch it. You'll be able to see the slides, and we'll help you out. So have a great night. Thank you guys for being here. Appreciate it, and we'll see you soon.